All right, that's it for everybody. So thanks so much for everyone for being here. Really appreciate it. Hope everybody is staying warm. My name is Andrew Postel. Today we will be covering taxes. Yeah, an exciting subject, but one I wish I could go into more, at least more often. You know, there's oftentimes somebody that comes in front of me that has filed their taxes and it's too late to change them. So today we're going to try to work on what to deduct so that you can still qualify for a mortgage. I hope that makes sense how I'm describing it. If you're self-employed, sometimes it's hard to qualify for mortgages because of all the deductions that we make. It's just part of what we do. So today we're going to cover maximizing our deductions while qualifying for traditional loans. All right. So what is that exactly is the Drew 2? Well, the Drew 2 is me. I'm Drew. My name is Andrew Postel, but I've been in real estate for over 20 years, specifically as a real estate investor. I'm also a loan officer. I'm in the top 1% of the whole country of loan officers. Very fortunate to be there. I lend in all 50 states, but this is not a big sales pitch to do loans. This is about how to file taxes. The Drew 2, every time we do it, every 2 weeks on Tuesday at 2 o'clock. It's all for branding, of course, but we're here to give free information for you. All right, that's the point of this. And when I talk about real estate, I'm talking about residential real estate. So, you know, warehousing is cool and gas stations are fine, but we do 1 to 4 unit properties. That's what kind of real estate we handle here. And then if you want to follow me on like Facebook and Instagram, I actually do a 2-minute or less thing every day there, just sharing information about mostly real estate investing. But you can also contact me. My contact information is below. This is my direct email, my direct phone number. You can call me there at any time. And appreciate everybody for being here. All right. So why are we even talking about taxes today? The main crux of it is I want you to understand that there are 2 main types of mortgages in America. And the 2 main types of mortgages that how I classify them are government loans and portfolioed loans. So government loans are loans that come from the government, like directly from them. It's their own money, like the federal government grants it. And what does a federal government do? Well, hey, if they create the loan, it's their rules. Like they choose what the rules are, and we go to them. It's not even up to the bank. So this is like loans like FHA. That's the Federal Housing Authority, USDA. I mean, that's literally the United States Department of Agriculture. So these are federal departments, and even Fannie Mae and Freddie Mac are owned by the federal government. So if I'm going to get a federal mortgage, what do you think they want to see from us? Our federal tax returns. And this is where the rub comes in. I'm deducting everything I possibly can to reduce my taxable income, and they need me to show more income. So today we're going to cover what deductions you should be making to help you qualify for more federal loans. Hope this makes sense how I'm describing it. All right, now just in case, the other types of loans that are out there are portfolio loans. Yeah, portfolio loans. These are loans that don't come from the government. They come from the lender's own portfolio of money, their money. They make the rules. You do not have to have any income to get a mortgage. You don't even have to have a credit score to get a mortgage. Now, if you want an FHA mortgage, you do, because that's federal money. They created those rules, and most banks lend on those because they're low risk for us. So if I'm a lender that might be doing my own thing with my own money, guess what? My money's limited. It's a bit more risky for me. So my rules will be different. And when I say different, they can be jerks about it too. So I'm not talking out of school. I don't think too much about this, but Chase Bank, yeah, they actually give portfolio loans, and you have to have $250,000 of money to even see them. How does the average person do that? And they can't. And this is where the rub is for a lot of us. There are portfolio loans out there that you haven't heard of because you didn't even know that they existed. Just call me. We can talk it through. If you ever need anything like this at all, I'm here to help, okay? So back to our tax discussion. One of the things I also want you to understand, not only there are 2 different types of mortgages, but there's this thing that they often will talk about. You know, lenders, DTI. Hey, what's your DTI? What is DTI and why is it even important? Well, so debt to income. DTI stands for debt to income. It's the ratio, like your total income, how much of your total income goes towards your debts, like your credit card, your car payment, your student loans, not your bills, your debts. So for example, if I'm doing a 50% debt to income, that means that half of my income is towards personal bills and the other half is towards credit. So my personal bills, like my cell phone bill, my utility bill, even my groceries, everything comes over here on one half. And then debts are like, yeah, my credit cards and everything. So if I'm doing a 50-50, I mean, I can have, that's a pretty generous number if you think about it, because not only these are just debts, but everything else goes over here. This is how they do it. Even your income taxes. So here's what I mean. If I'm starting to take something that's not personal and I put it over here in the business side, it could throw my debt to income ratio off. On government loans, I can even go higher than 50%. I can. That means more than half of your income is going towards bills. Ooh, that could be pretty steep for some people, but it's allowed on the federal side. But mistakes whenever we're self-employed, right? If you listen to how banks talk, do not assume that because one bank said it, that means all banks say it. There's 8,000 different lenders in America. I'm hoping that you hear something new here today, and I'm just one person. Do not take one person's answer as all people's answer. The other piece of the puzzle is when you're putting Sally's ballet class in your business deductions, it's going to throw your numbers off. It will. And I'm not the tax police. I don't mean to be judgmental about this, but I want you to understand that if you start putting personal expenses in your business column, nobody's going to be able to get you a loan. Now, at least not a federal loan. We can always get the portfolio stuff, but just understand that what we do on our tax returns gets measured in the federal space, which is what we're talking about today. All right, let me go actually to some tax returns. So our tax returns are broken out into schedules, and they're pages. Schedule A, B, C, D, E. They each do something different. Like Schedule B, for example, that's where your interest goes. You know, that 0.01% interest that you make on your savings account. That, you know, so when you get your 48 cents, you put on Schedule B, and that's income that you claim on your Schedule B. Each schedule is for something different. So Schedule E is for rental properties. Rental properties. Here's a page from Schedule E. Now, this is somebody's actual returns. Schedule E. But I cut off the top, okay? Please understand that at the top is somebody's name and their social security number, so I just cut it off. And I also cut off the address of the property that we're going to be talking about here today. So under this example of Schedule E, there is a column A, kind of in the middle of the page, that represents one property. So at the very top, there should have been a line A, but I cut that off because I don't want you to see the person's address of their property. This is just talking about the income. And the way the concepts of it work is the IRS says, hey, put your income at the top and then make your deductions below it. And at the bottom is our taxable income. So how this reads, there's line 3. If you can see it on your screen, it says rents received. That's our income for this property, 30 grand. They made $30,000 on this property. That's the gross, 30 grand. Now through all the other lines are our deductions. And at the bottom, line 21, that's my taxable income. They made $30,000, but they only have $50 of taxable income. Pretty good, huh? But some of these are extra things they had to pay. They come out of pocket. These are true expenses, but some of them are not. And that's not how much tax. I don't pay $50 in taxes. That's just my income. So my tax bracket is 10%. That means I owe $5 of income on collecting $30,000 of rent. But there's certain deductions I want you to understand on this schedule that you need to be claiming. Like, for example, insurance. That's line 9. This person's insurance was $4,700. I get to add that back as a lender. You should be claiming that every time. Every time I want you to claim mortgage interest, property taxes, and then this other thing called depreciation. Now, property taxes, I actually pay those. Those come out of my pocket. Depreciation is not something that comes out of my pocket. It's something that's spread out over a year. Every year, somebody's making my value lower because they're wear and tearing on my property. That's a tax deduction that I get to claim. That's why people like real estate. I don't pay it, but the equipment or the property or the real estate is degrading every year because somebody else is using it. That's called depreciation. Claim it every time. The other thing that you get to claim too, that we get to add back as a lender, condo association fees, homeowners association fees. And I'm saying this for a reason, my friends. I see tax returns all the time, and they don't have this stuff on there. It drives me crazy. How can you not claim your property taxes? This person's property taxes were $8,300. That's a huge deduction that they would have. So make sure you claim your property taxes and all these other things, because then your lender gets to add it back. You claim the deductions, reducing your taxable income. We get to add it back to help you qualify. Some other things about this schedule specifically. Line 14, this is where your repairs go. Sometimes you have maintenance, like a paint job or something, and you had to fix the washer, or I don't know. And sometimes it's like my whole roof had to be replaced. If you want, there are certain things that you can add here that are one-time add backs that we get to add back, like a big ticket item, like an HVAC. Make sure you're claiming those. You can depreciate them. Talk to your CPA about this too. You can certainly depreciate it over time, but if you want it to be added back that year, maybe to help you offset some income, and then your lender can add it back. If you're looking for a mortgage, it might be a good time to consider that. Even though I'm a lender, I'm just telling you the schedules of what we can do, of how we qualify your income. I still want you to work with your CPA on what deductions make the best sense for you. Some mistakes on this page. Fair rental days. Man, this happens so much. So if you can see it at the kind of in the middle and the top there, fair rental days, it says 365. This will often happen. Somebody will make $1,000 of income, and it will say they owned it for 365 days. And I go, hey man, what's going on with this property? This looks terrible. You're losing money left and right. What do you mean? We only owned it for 1 month. Well, not according to your tax returns. It says 365. Happens all the time. Check your returns. Make sure your fair rental days are accurate. If you didn't own the property the whole year, you shouldn't be claiming the whole year, because that'll make you look worse to most lenders. And then also the issue I have on this one is when people claim their automobile deductions here. All right, so my automobile deductions, there's a better place for it because I get to add it back on a different schedule. So if you're thinking about claiming auto deductions here, I want you to use it on Schedule C. Schedule C. Schedule C is where my sole proprietorships are made, my single member LLCs. Okay, this is some screenshots of it. Same type of thing. The income goes at the top, expenses, my taxable income is at the bottom. Here's your deductions that we get to add back for Schedule C. Depreciation. Sounds familiar, right? Business use of income. Yeah, if you have a home office, and if you don't drive to work, you don't have a work office, you get to deduct that. Again, talk to your CPA about the specifics, but if you do not have an office that you go to and you work from home, it's your right to reduce your income by claiming that deduction. And then the third thing is, this is where we want to claim mileage, because under lending rules, federal lending rules, we get to add back the business mileage if it's on Schedule C. That's the only place we get to add it back. So, for example, if you can read this person's tax returns, they showed $9,600 of income. And then line 31 is their actual true taxable income, negative $6,000. So if I use them business miles, now they have negative $5,800. Okay, so this person, maybe it's not the best example, but they got $1,000 for claiming their mileage here rather than somewhere else. Now this person, they're not going to qualify for a federal loan because they, obviously you only made $9,000 to begin with. And according to them, they spent $13,000 in advertising. All right, maybe they just started out, maybe it's a side hustle. But the one thing I want you to look at, 18, they had some sort of an office expense. Now, let's say, for example, they bought a printer. And it was $480 for that printer. Talk to your CPA about how I can depreciate this over time. If it's a piece of equipment, maybe I can depreciate it over time. Because if you can, then your lender gets to add it back. This person also, line 30, did not claim business use of a home. This person could look better to a lender. Maybe not get in the door, but they could have looked better. All right, on to some more schedules. Hope I'm not going too fast. Again, this is recorded. I'll post it here shortly, but I want us to go over some concepts and know that you can get things that are added back. Oh yeah, Common mistakes, right? Not claiming the home office, not tracking mileage. Oh, and not claiming depreciation. We just talked about those. I actually have a mileage tracker on my phone. Yeah, it's an app on my phone that I use. It tracks the mileage for me. I have to go back and say, hey, is it business or personal? It's super easy to use, but it tracks all my mileage for me. The one thing to be careful about on this page is your travel meals. Okay, so sometimes I'll have people you get to claim half of your meals, but not meals that are marketing meals. Half of your income, half of your meals can go here. Make sure you're claiming the right meals. If it's a marketing event, it shouldn't go into your travel meals. Claim them in the right place. If you claim meals here, you only get to claim half of them. So by rule, we have to ding you for another 50%. That's one that will count against you even further. Try everything you can to put the food budgets, the parties you're doing in the right place so that you can make sure that you're not hindering yourself on your tax returns. All right, S Corps, C Corps, partnerships. All right, these are some of the screenshots from what they come from, 1065s, 1120s. So this might sound pretty basic for this, but I'll go over it anyway, just in case. But you can absolutely use your income that you have that you give yourself to qualify, okay? So that's your W-2 income. On your K1, it's line 1. We use that to help you qualify, absolutely. We get to add back depreciation. Man, this is like a common thing. Depreciation, absolutely. But I want you to be careful. When you go to a lender and they say, hey, we need you to be in business for 2 years. That's not right. Not only is that not true, you can get a mortgage right away, but you have to have tax returns for 2 years. And guess what? Every new business owner's tax returns say the first year. They're terrible because they had to spend all this money to get started up. So just because you're in business for 2 years does not mean you qualify for a federal loan. You need 2 years of tax returns, and often that first year is a pretty hard year to have. And then the other thing too, I thought there was another thing. Oh yeah. If somebody tells you, all we need you to do is just give yourself a W-2 and it's fine. That is not fine. Once you go into underwriting, they'll learn that rule that that's not fine. You're still self-employed. It's still the same math. And if you have any questions about this stuff, all you got to do is just call me. I'll go over your tax returns with you before you file them. I'll tell you if you have a shot at getting a federal loan. And don't forget, if you missed the beginning, you can get a normal loan. There's other loans out there that aren't federally backed that you can get. And just the rate and the down payment is a little different, okay? If you have your mortgage paying your company paying your mortgage, understand it has to be for 12 months before it goes away. It doesn't completely absolve you just because they start paying it. Your company can pay for things, but there needs to be proof that it's being paid for 12 months. Keep that in mind. All right, so some takeaways here. This is only 22 minutes. I know it's always quick, but we want to get you back on your day. Maximize your deductions. Make sure you work with a lender that understands these rules and give you guidance about them, what you should do with your CPA's consultation, of course. And then here's some filing dates just to keep in mind. You can already file your tax returns. Yeah, January 23rd. You can start doing it right now. The first date to file, if you have a corporation or business, you have to file early because I need it when I file my normal personal returns. If I file personal returns, I need my business information from you. So your business corporate returns are March 15th. And this year, April 18th, because the 15th is on the holiday. So 18th for your personal, but you have extensions, September 15th and October 16th, respectively. All right, now, in 2 weeks, we will be covering a first-time home buyer workshop. I'll be covering it at length for 22 minutes, how we always do it. Every 2 weeks, 22 minutes, 2 p.m. Central Time. I think I've got a couple minutes here to answer some questions. I did keep everybody on mute, so if you have anything that you'd like to ask, please take yourself off mute. Let me check the chat here for a moment here. Oh, where are my recordings? I put them on YouTube. And thanks so much, Alex. Appreciate you. Thank you. Are there any questions that anybody has? Just take yourself off mute. If you have a question, chances are probably somebody else has it as well. If we don't have any questions, thanks everyone for being here. And that's it. That's the end of our discussion today. We'll see you in 2 weeks. Stay warm out there. Good day, everybody.